Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, so right now the United States is basically held captive for the materials required to build the future.
Right, the critical minerals.
Exactly. I mean, if you want to manufacture an electric vehicle, a wind turbine, an MRI machine, or even like a next-generation fighter jet, you are heavily dependent on a supply chain that's just dominated by China and Russia. It's a massive geopolitical chokehold.
And Energy Fuels is the company trying to break that chokehold?
Right. They're actively executing this structural pivot to transition from being America's leading uranium producer into a fully integrated Western critical minerals powerhouse. But man, the market setup here is wild right now.
Yeah, the stock is experiencing some violent volatility.
We're talking down 36% in a single month, but that plunge comes directly on the heels of a parabolic 153% gain over the past year. It's a fascinating setup.
Before we dig into this high-stakes situation, I want to mention a really useful chart tool for investors and traders, especially with a chart this volatile,
Oh, definitely.
If you want help reading trading charts more clearly, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite that displays visual buy and sell chart alerts, trend direction tools, support and resistance zones, and take profit and stop loss planning areas.
And it works across a ton of markets, right?
Yeah, stocks, Forex, crypto, gold, indices, futures, and more. But keep in mind, VIP Algos is an educational chart analysis tool only. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee profits.
Right. Trading always involves risk.
Exactly. So you must manage your risk and do your own research. And just a disclosure, the link below is an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Good to get it out of the way.
All right, let's move into the wealth building context, because looking at the sheer volatility of the stock, it demands a very specific type of portfolio fit.
It really does. When you evaluate energy fuels, you're evaluating a transformational growth play. This is no longer just about extracting rocks from the ground.
It's a geopolitical play now.
Right, it's a play on geopolitical premiums. We are talking about a long-term strategy that is heavily dependent on capturing a rapidly shifting global supply chain.
The analogy that usually gets thrown around for companies like this is the whole cash cow funding a moonshot idea. A boring legacy business internally funding a futuristic startup.
Sure, I've heard that one.
But looking at the actual mechanics of the rare earth market here, I honestly think that metaphor falls flat. Energy Fuels isn't building a speculative software startup. What they're building is more like a heavily guarded toll booth on the only highway out of a gold rush.
Oh, I like that framing.
Yeah, because if an automotive company wants to build a permanent magnet motor in the West, they are eventually going to have to pay the toll at Energy Fuels processing facilities.
That is a much sharper way to put it, because that toll booth aspect is crucial. They are attempting physical integration.
Right.
They aren't just mining the materials. They're
Yeah.
trying to process and manufacture the alloys themselves. If they succeed, they own the entire vertical supply chain, which is where the real wealth building potential lies.
But let me push back on that for a second.
Yeah.
Because owning the entire supply chain sounds great in a boardroom, but it is incredibly complex to build in reality.
Oh, absolutely.
So if I'm a conservative investor who just wants steady, predictable exposure to commodity prices, this dual identity, uranium miner mixed with a rare earth manufacturer, it might feel far too speculative. It introduces industrial execution risks that a pure mining play just doesn't have.
That is a perfectly valid hesitation. Look, if you are looking for a pure, simple uranium tracking stock, this narrative has moved past that. For you, the listener, the takeaway is that this is a multi-year narrative.
It takes time.
Right? It requires patience. You have to be comfortable with a complex execution timeline because the payout relies entirely on them bringing these processing facilities online successfully. That gives us the bigger picture. Now let's look at the fundamentals.
Let's start with the legacy toll booth, the uranium engine, because the numbers coming out of it are formidable. In the first quarter of 2026, their uranium revenues hit $35.7 million.
Wow.
Yeah. On the production side, they're expected to reach 1.6 million pounds of finished uranium at their White Mesa mill by June 30th.
To put that in perspective, reaching 1.6 million pounds by mid-year entirely eclipses the lower end of their full-year guidance, which they initially set at 1.5 million.
So they're crushing it on efficiency.
They are operating at high efficiency.
Yeah.
But honestly, the metric that truly separates them from the rest of the critical minerals space is their balance sheet.
Right, because usually in the junior mining sector, dilution is just an accepted nightmare.
Exactly. Companies constantly issue new shares, watering down your investment just to keep the lights on.
Yeah.
Energy Fuels, however, is sitting on a staggering $956.6 million in working capital.
Nearly $1 billion in the war chest.
Yep.
And the margins feeding that cash pile are equally impressive. They have secured U.S. utility contracts locked in at $90 per pound, while their production costs at the Pinyon Plain mine are sitting between $23 and $30 per pound.
Yes, and that margin is exactly what funds the rare earth pivot without punishing shareholders through near-term dilution.
But here is the fundamental contradiction I need help reconciling. We have nearly $36 million in revenue, fantastic margins, $1 billion in the bank, and yet they reported a Q1 net loss of $10.8 million.
Right, the net loss.
Yeah, if the uranium business is printing cash, why are we looking at an $11 million hole for the quarter?
Because building a new industrial supply chain from scratch is punishingly expensive. That net loss is not an operational failure of the uranium side. It is aggressive, calculated reinvestment.
Ah.
They are pouring capital into the infrastructure required for the rare earth expansion. And the market entirely expects this. Consensus estimates expect 2026 revenues to jump 123.4% year over year to roughly $147.27 million.
It's a massive jump.
And by 2027, they're projected to swing from these reinvestment losses to a 6-cent per share profit.
So we're basically trading short-term capital expenditure for long-term structural dominance.
Precisely.
And that brings us to the moat, which is arguably the most fascinating fundamental aspect of this entire company. We hear the term moat thrown around a lot, but this is a literal physical monopoly. The White Mesa Mill in Utah is the only operating conventional uranium mill in the U.S. that can commercially process monazite.
And we should pause and explain what monazite actually is, because it is the linchpin to this whole operation.
Definitely.
Monazite is a phosphate mineral that is incredibly rich in the rare earth elements needed for high-tech magnets. The problem, and the reason everyone isn't just digging it up and processing it, is that monazite is highly radioactive.
It's dangerous stuff.
Yeah, it contains significant amounts of thorium and naturally occurring uranium.
Which means you can't just toss it into a standard chemical plant. If you want to process monazite, you're dealing with radioactive tailings, which requires a highly regulated, federally licensed uranium mill.
Precisely. And obtaining the environmental permits, navigating the regulations, and constructing a facility to handle radioactive materials in the U.S. takes, at a minimum, a decade. Probably closer to 2 decades today.
So the barriers to entry are just astronomical.
Completely. Even if a competitor materialized tomorrow with unlimited funding, they legally cannot build a competing facility to process monazite in under 10 to 20 years. That is an irreplaceable fundamental moat.
That gives us the business picture. Now let's move to the catalyst timeline.
The timeline is dense, but the standout event is the July 2026 closing of their Australian Strategic Materials, or ASM, acquisition.
This feels like the moment the company actually transforms.
It absolutely is. Up until now, Energy Fuels could mine the material and separate the rare earth oxides.
Yeah.
But oxides don't go into a Tesla motor. They have to be turned into metals and alloys.
Right.
The ASM acquisition adds an operating Korean metals plant and a planned American metals plant to their portfolio. Once this closes, Energy Fuels becomes the absolute only Western company that can mine the uranium, separate the rare earths, and manufacture the alloys.
They capture the profit margin at every single step of the vertical stack.
Exactly. And shortly after that closes, we have their Q2 earnings coming up in August, which is a major catalyst to watch.
But the internal company catalysts are only half the story. The macro environment is providing some incredible tailwinds here. Geopolitics is practically forcing this stock into the spotlight.
Oh, without a doubt.
Like, the U.S. ban on Russian origin uranium is forcing domestic contracts.
And China's export controls on rare earths are creating astronomical Western premiums. We're seeing a 443% premium for dysprosium and 401% for terbium right now.
A 400% markup just because it's processed in the West. That's a staggering premium.
It really is. We should also briefly touch on the speculative pipeline, too.
Right, the potential binary catalysts, like the $1.8 billion NPV Madagascar project approval.
Exactly. And the potential 4 to 6 month restart of the Nichols Range project. Catalysts tell us what could change the story. Now let's pivot to the chart.
The price structure over the last year is a textbook study in extreme market mechanics. We noted the 36% pullback over the last month, but context is everything here. That drop occurred following a 153% parabolic run,
Right, and we have to highlight the high stock beta of 1.55 here.
which means highly aggressive momentum shifts.
Exactly.
From a technical perspective, I'd frame this as a washout of weak hands. The steep decline on heavy volume implies a capitulation event, setting up a new base where smart money, value-oriented buyers might step in.
Yeah, and honestly, highly volatile charts like this are exactly why traders use visual support tools like the ones we mentioned earlier to plan their levels.
So the chart gives us price structure. But what does market sentiment look like?
Wall Street is currently cautiously bullish. The consensus is a moderate buy with a massive 78% upside. The average 12-month target is $25.75 versus the current $14.46.
It's fascinating that the news flow views the drop as basically a dip worth buying. Goldman Sachs even maintained a buy rating, though they conservatively lowered their target from $29 to $21.
A big part of that institutional confidence is the transition to new CEO Ross Papu. He's bringing a narrative of schedule certainty and capital efficiency, which is exactly what institutional capital wants to hear. That sentiment picture is useful, but we still need to talk about the risks.
And we really have to bring heavy skepticism here. The capital intensity and execution risk are massive. The Phase 2 rare earth expansion requires a whopping $410 million in capital expenditure.
It's a huge sum.
Yeah, if integration with ASM struggles, drawing down that massive $956.6 million cash pile could deeply spook investors.
There is also the reality of commodity volatility. The company relies heavily on uranium spot prices, which remain volatile. They also depend on monazite feedstock from projects that are mostly still in development.
Right, which explains why Zacks recently assigned a rank 4, or a sell rating, reflecting this near-term sentiment risk.
But to objectively counterbalance that, there are strong mitigation factors. The Phase 2 expansion supports a 33% IRR and returns $4.60 for every dollar invested, funded largely by those $90 per pound uranium contracts.
So with everything on the table, what's the final verdict?
The research yields a bullish score of 9 out of 10. The stance is strongly bullish, but geared as a multi-year hold for 12 to 24 months.
So for the listener, the summary is, the upside driver is the irreplaceable 10 to 20-year moat at the White Mesa Mill and their status as a fully integrated critical minerals powerhouse.
But the risk is short-term commodity volatility and execution costs.
Just a reminder, this is an analysis of the research, not direct financial advice, and you must manage your own portfolio. And before we go, don't forget to check out VIP Algos through the link below in the description. It's a TradingView indicator suite for clearer chart reading, giving you visual alerts, trend tools, and planning areas. Remember, it is an educational tool only, not financial advice, does not place trades, and guarantees no results. Trading involves risk, and you must do your own research. We may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.